Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm a managing principal and a portfolio manager at T2 Asset Management. Before we get started, this video is for educational purposes only. Opinions expressed in this video are mine, do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, we got a lot to cover this month, but before we get into my outlook, I just wanted to address a couple of the big headlines that everyone's been hearing about, in particular how the retail investor happened to crush a big hedge fund that was a short seller. First of all, let me say that I'm always glad to hear about the average person making money in the stock market. God knows that the hedge funds are always on TV talking about their investments and what they like, what they don't like to match what they're doing. So when the average person finds an opportunity, I simply say congratulations. Now, that said, let's not get too far ahead of ourselves. There's always that person that walks into a casino, puts $100 on 23 red on the roulette table, wins $3,500 and thinks he's going to break the casino. You need to remember, there's a lot of people that have tried to break the casino only to walk away broke. And that brings us to today's day traders. By now, you've all heard about GameStop and how the Robinhood traders were able to destroy that large hedge fund. Here we have a chart of GameStop stock and the meteoric rise that it had in January. If you were lucky enough to buy GameStop at $10 or $20 a share and it shot up to $300, good for you. However, the media craze around this stock has me concerned that too many people have bought into that hype and were buying GameStop in the 300s only to see that their investment fell to $50 in a matter of days, not weeks. Now, it's easy to talk about the winners, and we hear all sorts of people talking about how much money they made, but you rarely hear about the people talk about their losers and their losing bets. I've been around for over 25 years, and I've seen this movie play out, in particular back in the 90s, so I just hope that you're all very careful out there. I know how this movie ends, but I did want to touch base a little bit on and put some context around this GameStop stock. Back in January, GameStop had a market cap of about $24 billion, and that placed it in the top 300 largest company in the country. Just for some perspective, GameStop was bigger than Fifth Third Bank, Northern Trust, Expedia, Hartford Financial, Halliburton, MGM Resorts, CarMax, HP, you get the point. But what happened? What about the fundamentals? What is it that you're buying when you're buying stock? You're buying earnings. Well, in 2017, GameStop had net income of about $353 million, and its market cap was about $2.2 billion. Their most recent fiscal year has them losing about $464 million, and yet their market cap was up tenfold in January to about $24 billion. This Reddit phenomenon with GameStop is a game of musical chairs. It's as simple as that. I just hope that if you had made some money on this, you pocketed it, and if you were unfortunate enough to buy it at the highs, I hope you at least limited your losses. Like I said, I want people to make money. I just think this isn't the way to do it. I'll leave you with one last thought on this before we move on, and that's the SHOESHINE boy indicator. Back in 1929, Joe Kennedy Sr., who's the father of the late President JFK, claimed that he knew that it was time to get out of the stock market when he got investment tips from his SHOESHINE boy. Well, I had some furniture delivered to my house at the end of January for my daughter, and my delivery guy was asking me about GameStop and how he had a friend telling him to buy some. I guess I now have a delivery man indicator. Anyway, these trends have happened over time, and I expect them to continue in the future. It did happen in the late 90s with the tech bubble and the emergence of day traders, and it happened again during the housing crisis of 2008 with the emergence of house flippers. The question today that everyone has to ask is, will it happen again in 2021 with the Redditt traders? And like I've said before, I've seen this movie, and I don't want to ruin the ending, but it's not going to be good. So I think it's important to understand how we got here and understand that speculation is not investing. So let's just take a look at this timeline here. First, the pandemic that we were exposed to back in March of last year forced the government to shut down our entire economy. People were forced to stay home, worried about the future, and trying to figure out what they're going to do. When the government sent out some money, they started providing checks so that people could get by. These people, they started to read social media posts on how to beat the market and figured, what the hell, it's free money. A few of them got lucky, maybe made some money and figured this is just an easy way to supplement my income that I've lost. But then greed kicks in. If I can make this much money buying stocks, imagine what I can do if I use options and leverage everything 100 times. This is where we are today. They may have some initial success with trading, but eventually reality is going to strike and losses is going to start to accumulate, and that's when the music stops, and I just hope you're left with a chair and not without one. Now, retail speculation is one thing, but there is risk across the board that investors, not speculators, need to worry about as well. So let's take a look at some of the policies that got us here. First, the Fed drops interest rates to zero and promises to keep them there forever. But that's not enough. They also start monetizing our debt by buying bonds across the board. This forces investors to take on more risk since they can't really earn anything on these safe investments. And then Wall Street realizes that there's an opportunity to take advantage of these zero interest rate policies, and they start getting creative. By now, you've probably heard about the new SPACs that have been issued over the last, 8-9 months. These are basically blank check companies that buy private companies and so they can go public. Not a big deal, right? Just like it wasn't a big deal when Wall Street created CDOs prior to the housing crisis. Now, I'm not saying that SPACs are the same thing or they're going to end up the same way, but they are paying huge amounts of money for companies that are losing huge amounts of money in hopes that these companies simply turn a profit in the next 5 to 10 years. But remember, these SPACs have nothing to lose. They take investors' money, they collect a fee for structuring the deal, they collect a management fee, and they get a kicker if things work out. I think you get the point here. Now, the zero interest rate policy, all the printing of money, all the government spending, that's all going to lead to higher interest rates and thereby higher inflation. This is where we are right now, and I'll get to this with a little bit more detail in my outlook. But after interest rates rise sufficiently, that's when the selling is going to start to take hold. The repricing of stocks is necessary because as they're being valued on based on interest rates when they're at zero, and as interest rates increase, they're going to need to use a higher discount rate to discount the future earnings of these companies. And that's going to cause prices to fall and revalue at lower prices. And finally, when prices fall far enough, institutional investors will be there to scoop them up at huge discounts, and the cycle will almost certainly repeat. Meanwhile, the Redditt traders are probably not going to be faring too well by that point. Now, you may be questioning my thoughts right now since it appears that inflation numbers are very low. If you take away anything from this video, it's this. Official inflation numbers should be taken with a fistful of salt, not a grain of salt. Have you ever wondered how inflation can be so low for so long, yet you seem to have less and less money even though you aren't shopping any differently? Well, the answer lies in how government reports inflation. These low inflation numbers are driven by substitution and harmonics. Substitution is what it basically says is that if the price of steak skyrockets, for example, you will just simply switch to cheaper hamburger, and just like that, no inflation. And then there's harmonics. This basically asks how much of a product's price increase is a function of inflation and how much is quality improvement. Let me give you an example. Let's say a computer last year cost you $1,000 and a computer today costs $1,200. You and I would say that's a $200 price increase. But not so fast. The government can say that you are getting a faster computer with more stuff that's worth about $200, so the price is actually $1,000. Presto, no inflation. So let's see what some things cost. Here we have a chart of various components over the last year. The blue line here is aluminum. It's up over 100% in the last year. Chemicals, they're up over 30%. Steel, up over 36%. Containers and packaging are up nearly 30%, and I think you get the idea. So that people don't think I'm cherry picking certain industries, here's a chart of the Bloomberg Commodity Index ETN, which clearly shows how much it's run over the last year. It's up actually over 40%. So the whole basket of commodities is up a significant amount over the last year, and my expectations are that it'll be even higher once we get March and April, after we get through March and April. Now, I know that inflation isn't showing up quite yet in the core and headline numbers, and there's a reason for that. For inflation to really heat up, the velocity of money needs to pick up. The velocity of money is basically the rate at which money is exchanged into the economy. And so when velocity is typically higher when the economy expands, and it's lower when it contracts. Looking at this chart here from the St. Louis Fed, you can see that the velocity of money is outrageously low and has been the main reason we haven't seen any real inflationary pickup. However, it will turn higher, and when it does, it may be too late. The velocity data comes out too late to really react to it, so we need to find other indications of inflationary risk and inflationary pressures. Which brings us always back to the bond market. The bond market is what drives everything in the financial system, and the 10-year is the barometer. So here we have a chart of the 10-year Treasury over the last year, but most importantly, the last month. The 10-year Treasury yield is 50% higher in just the last month and has nearly tripled in the last 7 months. It went from 1% at the end of January to 1.5% at the end of February. Now, you may not think this is a big deal, but it is. It's a really big deal when you're talking about a $50 trillion bond market in the U.S. that's priced off the 10-year Treasury. In the bond market, there's a rule of thumb. It says you can expect interest rates to generally move about 50 basis points in either direction over a 6-month period. Well, we just saw that happen in 1 month. Interest rates will continue to move higher. Simple math tells you that the 10-year Treasury should be probably closer to 4%. The 10-year Treasury is basically a reflection of real GDP and inflation. And if the real economy grows at about 2%, and you believe this inflation rate that's being publicized at 2%, that's 4%, and the 10-year Treasury should be there. Now, obviously, the Fed is manipulating the yield curve, but they're not going to be able to do that forever. I think the most important thing is that bond investors need to be very, very careful here. As interest rates rise, the bond prices are going to fall, and they're going to have a pretty terrible performance in the future. So while we haven't seen inflation get hot yet, it is coming. We've already pumped in $4 trillion into the economy, and right now Congress is looking at an additional $2 trillion. So there's a lot of money slushing around the financial system. The economy is starting to reopen, and it'll continue to reopen throughout the year. As the economy reopens, the velocity of money is going to increase, and with the velocity increasing, along with the trillions of dollars sitting around waiting to be spent, inflation's going to pick up, and that's going to lead to higher rates. And finally, stock prices will need to reprice to reflect the higher discount rate, at which, in essence, is going to cause stocks to fall down to more reasonable valuations. Now, over the last month or so, really since basically the end of January, I've been de-risking my core equity holdings and have positioned my clients defensively. Investors need to prepare themselves for higher interest rates and the implications it'll have on their investments. If you are able to, you should probably hedge some of your stock exposure. If you can't hedge or don't know how to, it's a good idea to sell some of your stocks and hold cash. This is not the time to be greedy. Remember my delivery man indicator or the SHOESHINE boy indicator? Valuations only matter when they matter. And as rates rise, you're going to see the importance of valuations. And finally, have some sort of disciplined process with regard to what you're doing on your investments. I don't expect everyone to have a process that is as detailed or specific as ours, but having any process is better than reading some posts on social media. And remember, if you're not comfortable creating a process and investing for yourselves, you can always reach out to us. We're always adding new clients to our business and would be more than happy to help you. As always, thank you for watching, and if you should have any questions or comments, please give me a call or send me an email. Until next month, I hope you guys do well, and I hope that you come and visit us again next month. Thanks.